Good morning, good evening, good afternoon, whatever time it is for you, wherever you are right now. And welcome to another session of Bizarre Financing. I'm Gordon Bizarre, and today our topic is a phenomenal tool called a SAFE. It's designed to raise capital for young or startup businesses that don't have a history or a track record to do a proper valuation. And what it does simply is it allows you to pay for your capital, not with a valuation on what your company is worth today and a number of shares that would relate to that, but it enables you to pay for it with shares once your company is able to be valued by issuing shares to the investor at that time at a discounted price, and actually a fairly deeply discounted price. And that may not all make sense to you right now, but it will when we get done, because I'm going to go through this with you step by step and show you exactly what it is and how it works. But I will say this, that this is the greatest tool that we have found for raising money for businesses where it's hard to create a value on them because you're so young. It's also a great tool, as you'll see, for actually paying for companies that you acquire without having to come up with cash up front. So it's got a lot of uses. And I think when we get into it, you're going to love the tool and you're going to find it extraordinarily valuable. So buckle up. You're going to get a great tool here for raising startup or merger and acquisition capital using a SAFE. And SAFE stands for Simple Agreement for Future Equity. That's what it stands for. Now, in the usual format, we're going to give you an opportunity to ask questions. So write them down, type your questions into the question box or into the comments box, whichever one you have handy there. And it's on the right side panel. And then also raise your hand if you want to ask a question. I love it when people do raise their hand. I can open up their microphone and we can carry on a little bit of a dialogue, which helps to really refine the question and even peel down that onion a little bit and get underneath what caused that question in the first place. If we don't get to answer your question during the session today, just type an email to me, question@bizarrefinancing.com, and I'm happy to answer those for you. All right. I'm going to give you a hard case example. We're using this tool now to finance a company called Billionaire Lifestyles. It's a company that's involved in strategic aggregation. And the thing that it's aggregating is all of the various service businesses that cater to ultra high net worth individuals and their families. And so the ones that logically come to mind are companies that either sell or charter or lease or rent homes, mansions, Rolls Royces, Bentleys, all kinds of exotic cars, jets, helicopters, yachts. In other words, just think about all the things that wealthy people spend their money on. The list is a lot larger than this. The companies that we'll be aggregating also include real estate brokers. They include people who rent or lease a private island or sell private islands. It has to do with companies that supply security, both cyber and bodyguards and facilities security. It goes on into people who handle the money for investment for these people. It covers anything and everything that ultra high net worth people would spend their money on. And the companies that we're aggregating are the top of the line, high level companies, the best of them that are servicing these high net worth individuals. Right now, we're very active in acquiring jet charter companies. And you're going to see that when I go into the illustration here in a little while. But when you bring all these companies together and you put them into a common ecosystem, and then you bring to it a service that we have called Scale. It's a platform that enables all of these companies to cross market with each other. So as we acquire these companies that do these things, that service these high net worth individuals, we are able to then cross market their clients and make the clients of each of them the clients of all of them. And it's a very sophisticated process that we use to do that. It's all automated through Scale, which is a platform, the online platform in the cloud, as they say, that handles all of this. It automates the whole process. I won't get into it in any detail today because that's not my goal. My goal today is to share with you this tool called a SAFE, this method of raising money, what this agreement is, what it does, how to use it. And I want you to see by a hard example how we're using it to fund startup capital for Billionaire Lifestyles that pays for the operations while we're getting all these companies organized, and then also helps us to pay for the acquisitions in two ways. One is to raise money for the cash portion of the acquisition, and the other is to pay the seller in part with future equity that will be very valuable to them, more valuable than the original money they got for their company. And you'll see how it's an exciting tool to use and how Everybody just is fascinated by it and is extraordinarily successful at what we're doing. So now let me give you an example of what I'm going to show you. And I'm going to give you the result, the bottom line first. And then what I'm going to do is to work from the very beginning then, and then take you up to what it is that produces this result, so that once you know the result, you'll now see how it is that result actually gets produced. If you know where it's going, then when you start from the beginning, you already know where you're going. So it makes each thing that I explained to you a little more clear when you know the result that you're going to see. I want you to follow with me here. And what we're going to do is we're going to literally take, in this case, an example. I'm going to give you a complete example of how it works, including a model that we built. That's a Proforma model that enables us to project out all this stuff with a fair amount of confidence in what our future looks like. What we're going to do here is we're going to take 12 companies for our Proforma that in 6 years would be worth collectively on their own. And these numbers, by the way, here are in thousands. So this is $401,383. So the companies we're acquiring, 12 of them, if we just left them alone on their own, just their own Proforma projections, and then did a valuation on them based on their projections for what they're going to do into the future, these companies would be worth approximately $401,383,000. Okay, so that's this, and they would be non-liquid because none of these 12 companies would have an ability to go public on their own. Okay, so this is what they would be worth as private companies. Then we're going to combine them in an ecosystem, as I've been explaining. We're going to roll up their competitors into their companies. We're going to buy their competition and then roll them up into their individual companies. Remember, we own the companies now. So now we're taking the companies that we just bought into this ecosystem, and then we're going out and buying up all their competitors. And you're going to see where all the money comes from to do this. It's an incredible tool you're going to see here. Okay, we're going to deploy the scale platform, strategic aggregation platform, which is now going to cross-market the clientele of all of these companies one to the other. Okay, and then that will develop companies with a market cap, a total valuation of 17,928,000. I'm sorry, 17,928,718,000. Okay. Now, the way that this works is, just so I can carry you to where we're at, we're going to create leverage on leverage on leverage. And that's how you do it. In business, is all about leverage. How you leverage one thing to more things, to many more things, to phenomenally more things. All right. And so what we're going to be doing is when we take these businesses that alone are worth 401 million, but then what we're going to do is we're going to combine them together, cross-market their database, buy up their competition. Each one of these is a leverage point. Deploy the scale platform, and then IPO, which takes businesses that are worth 5 or 6 times earnings to businesses that are worth 14 or more times earnings. And so when we do that, we end up with leverage on top of leverage on top of leverage. And you're going to see in the Proforma exactly how this works out. You got a company that's now worth almost 18 billion as a public company. And what this does, if you look at the numbers, multiples on multiples, we're taking companies that would have been worth 401 million, and we're making them worth 45 times more than they would have been worth alone. So by this process, they become worth almost 18 billion. The companies and their owners who are actively participating in this process will be creating over $17 billion of new wealth. If this becomes this, okay, we've literally created $17 billion of new wealth. And the amount which has been earned by our platform partners, the people whose companies we bought, these 12 companies, is now worth $2,366,960,000 to them. In other words, that's the total amount that they will have been paid by the end of this process. So that at the end of 6 years, instead of being worth 401 million, these 12 company owners are taken to the bank $2,366,960,000. The amount they would have created on their own, this number here, multiplied by 5.9%. Now, what happened if we created 45 times and these people get 5.9 times? Well, that difference is almost 40 times. Who gets that, right? That difference. It's owned by public shareholders. It's owned by us. It's owned by a number of different parties who are who created the leveraging process and exploited the leveraging process to make that all happen. But all of our acquired companies, those sellers, got 6 times what they would have had they not done this aggregation with us. Okay. And some of our platform partners will substantially increase their results by a stock swap instead of composite upfront cash of 106 million, because what we did here is we bought these companies, not in year 6, year 1, and we paid them $106 million for their company. And then and we left them owning 25% of their company. But if they did a stock swap of their 25% of their company with us for shares in Billionaire Lifestyles, then we would have increased their value by that amount of money. Okay. So by a lot more money that they would be worth. You'll see how that all works out. All right. Before I move on, I just want to have you get this picture. Okay. So what I'm going to show you now is how $401 million standalone companies, when we put them together in this format, it's going to equal 17.9 billion. Okay. And how are we going to pay for these acquisitions? How are we going to pay for the initial money we needed until we got all this together to build this thing in the first place? We're going to get him using the SAFE agreement, the simple agreement for future equity. So hopefully everybody's got that picture now of what we're going to do. And we're going to take a hard example, which is exactly what we're doing as we speak right now. Okay. So let's take a first look at our model of what it is that produced all this here. We're going to just take it now a one step backwards. We're not going to start at the beginning. We're going to take one step backward and say, how did we get this number here? All right. What we did is we took what we called without acquisition, acting alone. Remember that net number I gave you for acting alone, 401 million? All right. This is their revenue in the year, projected into the first year that we own them. This is their revenue projected into the second year, third year, fourth year, fifth year, sixth year. And these projections came out of a very serious discussion with the 12 acquisitions that we're looking to make. And we went through with their projections of what it is they believe these companies would earn. We validated it. We agree with them. It's the reason we're buying the companies. And also based on their margins, these would be their EBITDAs. In other words, earnings before interest, taxes, depreciation, and amortization. So these companies that were producing this amount of revenue would have this amount of EBITDA. So 24.9 million all the way up to by their 6th year, they would be earning 75 million. All right. And their valuation their valuation would be these numbers here. So these companies producing these profits based on a 5 times multiple of their earnings. This is essentially what it is that they would be worth as a private company. Now, we don't show anything here as a public company because none of them would have the ability on their own to go public. That's another layer of leverage. We're going to add that in a moment. Okay. So valuation private, if or when, and here by you, we mean those owners, you can get someone to write you a check. Okay. Because even though the companies are worth this, doesn't mean they can sell them for that. Somebody's still got to write them a check and they still got to go out with a long process to find those buyers. All right. Let's take a look at the next level of leverage up. Okay. So we're going to add the acquisition, the roll up under each of our 12 verticals. Okay. So you've got their revenue now. Instead of it is still these amounts, but this is the amount that would be added by adding roll-ups. And again, I'm going to show you the model. I'm going to show you a little later on the projection process so you can see how we got all these numbers. But suffice it for now, this would be the estimated revenue of all of the competitors that we would roll up under these 12 different companies. This would be the EBITDA. Okay, this would be the valuation private. But now, because we've rolled up all of this, all of the 12 vertical companies and all of their, or not all of their, but a substantial portion of their competition, we now have a company that can go public. It will qualify for a high growth public company. And so now we start to look at going public anytime between the 3rd year and the 6th year. And if we went public in any of these years, this is what the company would be worth on a 14 times multiple of earnings. So here we projected 5 times. And that's what this is. The valuation private is based on 5 times earnings. The valuation public is based on 14 times earnings. So if this is our unit up here of what everybody would be worth if they were alone, that's 1. If we put them together and roll up their competition, these folks now become 7.2 times as much because we rolled up their competition. And what is interesting to note here is that the rolling up competition produces substantially more income than these guys ever would have made on their own. Why? Because every year we're rolling up 1 or 2 the first year, 2 or 3 the second year, 3 or 4 the 3rd year, 4 or 5 the 5th year. So ultimately, the dynamics of roll up produces a way bigger company than the original company that we bought, in which we made a platform for the roll up of all those companies underneath them. Because when did we buy them? We buy them because they had great management. They knew how to grow their company. They had a proven track record. They were making money hand over fist. And we just showed them a better business model. They rolled into our better business model. They became the platform company, and underneath them, we bought up all, or I say all because there's some industry we may buy all of them, but many will buy a substantial portion of their competition. And so that's the second area of leverage, leveraging the platform company that was a great company into now having control, that company managing and controlling a whole bunch of other companies that we roll up underneath them that they already know how to run profitably and have proven it. So this is the first level of then that additional leverage. Now, the next area of leverage is we now take these companies and we start to cross market them. Now, shows what happens when we cross market for verticals. In other words, and the reason I broke it down this way, remember I said we had 12, let's say, I broke it down 4 so you can see what happens as you add verticals into your cross marketing process, how that becomes another source of leverage. So here we have revenue again of what's created by scale. Once this is enhanced, this is unenhanced. So these are the same companies, but now we enhance with cross marketing through the cross marketing automation platform. Okay, so now these are additional earnings, and so now what's happening, since here we can go public and here we can go public, we've brought a company that would have been worth these amounts of money here in these various years to these amounts of money here in these various years. Now you'll notice there is a significant increase year to year, but it's not earth shattering. It's not earth shattering. Okay, it's great. And if you can do it, you would certainly do it. But I wanted to show you the difference between just taking 4 verticals in cross marketing versus 12 verticals and cross marketing. So here we've already brought a unit, these companies here, to where this base is now worth 7.2 times. And once you add the cross marketing, they're worth 10.3 times. And if you're taking it public, it's worth 22 times. Okay, so now we made one worth 22 times the amount by the way in which we layer leverage on top of leverage on top of leverage, public versus private, cross marketing, all of that. And then the last one here that I'm going to show you is what happens when you have 12 verticals. Okay. And what happens to the added revenue now, the difference between these two added here. So now with 12 verticals, what was an $8 billion or $8.8 billion valuation public here becomes a 17.9 valuation public here, or 44.7 times this. And you'll remember, hopefully, this number of 17.9 billion here, because that was the number I showed you on that prior slide that I went through with you. And this is now how we got there. This is the skeleton, the bones of how we got there. Okay, so this is what produced the 17.928, this 45 times, and this is just rounded off. If you don't round it off, it's 44.7 times. All right, so now I've stepped back into the actual composite of everything that we did to get here. And what I'm going to do now is take you one step down even below this and show you a little bit more of how it is that we got here. Basically, what we did is we built out, and we do this on all of our strategies and structures, we build out a very comprehensive pro forma model. And what it enables us to do is to take all of these various entities and do a pro forma on each and every company and then composite them together. And when we're all done with it, everything comes together and we're able to make changes in real time to see if we change in any way the multiples, the formulas, if we're adjusting the strategy, we can know in real time how that's going to affect us over this 3 to 6 year projection process and how we're going to get there. Basically, what we have here, simply enough, is this takes a platform company. This company had 130 million in sales. Okay. It had 12 million of EBITDA. It's a jet charter, what we call a fulfillment engine. Okay. And what that means simply is that this jet charter company operates its own aircraft. Okay. As opposed to a brokerage jet charter company, which is just sells other people's time on other people's aircraft. This company will either own its own aircraft or it will manage aircraft for people who own their aircraft and handle them through that charter process. And they handle everything that it takes for that company to do it. They're certified by the government to fly these planes and to be that charter facility that owns and operates the aircraft. So in any event, this company had this is real, by the way, these are real numbers for us. It's 130 million in sales. They do 12 million in EBITDA, and their valuation private is about 60 million. In other words, 5 times EBITDA. Based on their pro forma projections, this is what their revenue is projected out at. This is what their EBITDA was projected out at. This is what their valuation private would be based on those numbers. And if you'll recall, we did this in that composite that I showed you before. We composite different verticals or 12 different platform companies, of which this was one. So what you saw before was all of our verticals added composite together. Okay. Now I'm going through one different individual one with you. There's a public compliance cost for these companies that we have to deduct here in terms of what we're going to do with them. There's the public EBITDA of this. Okay. So if we're going to take them public, okay, and we need to combine the valuation public, we have a compliance cost that part of them is going to be allocated to them, but their portion of it. So that gets deducted from, in effect, their EBITDA is now going to be a little bit less than it was if they stayed non-public. But now this becomes the valuation public because this EBITDA is worth 14 times, whereas this EBITDA is only worth 5 times as a private company. So hopefully that makes sense to you and you got where these valuations come from. So these are the numbers that came into that other illustration that I gave you. But then we had other companies that were also composited in there that gave you those numbers for our overall company. Back to this individual company again. So now their external acquisition growth, this is what we projected for rolling up their different competitors. We looked at all the different competitors, their size. We did a very thorough study of the market. We have a really good understanding of the level of companies and their size and all of what's going to be true for those companies. And this would be their estimated EBITDA. Then the valuation added private was this amount of money. But then if we could take it public, we got to cover that compliance cost of actually doing the public offering. And this would be the new EBITDA, and this would be the added valuation for taking that company public with, this is what the roll-ups would add. Okay. Then this is the total valuation private of this. The value added public is this. The total value public is these numbers here. But then what we did is we carried it even further so we could show it to the sellers because they want to know what they're going to get out of it. And so we continue the pro forma here, and this is what we would be paying for the company. This is to the sellers. So this is basically what they would be getting out of it. And this is what the buying company ends up getting out of it. That's us. Okay. The equity valuation share public. This is what the sellers would be getting out of that company. So this company would be bringing the sellers almost $1 billion in money that they get from our transaction that they would have only had 200 million worth here. They end up with almost $1 billion here. On the other hand, from doing this, us and our investors have made 2.998 billion, almost 3 billion. Okay. This is the way this basically breaks down. All right. This is a composite now of just this one company. Okay. And what our pro forma is showing. And then we go through here and we actually give you the inputs that enabled us to get this. I wanted to show you how sophisticated our model is, because in order to get this, we had to create inputs that then had certain mathematical algorithms applied to result in the numbers that you saw. So this is where all the inputs were put into the system. So the 12 trailing months revenue, we put in 130 million. The EBITDA was 12 million. The revenue growth rate, this has been their growth rate for the last 4 or 5 years, 20% per year. So we projected that out into the future. This has been their EBITDA margins historically is roughly 9.2% on sales. But once we start doing certain things with them, we know that those margins will be increasing because of the leverage points we're going to make. This is the valuation we use for the value as a private company, multiples of EBITDA. This is the multiples of EBITDA we used as a public company. Then this model is based on us buying 75% of the company, giving them cash for that, and then 25% of the company they continue to own, and they roll that into the public company when it goes public. Okay. And so these are our different scenarios that can happen: full stock swap, partial stock swap. This is if they stay in and swap stock for Billionaire's lifestyle instead of keeping the money in their own company and then selling it at the end once we go public, or selling that balance in. Okay. This is our projection for the roll-ups. Companies are around 35% of the size of the original company that we bought, the platform company, the one that was base company that then did the roll-ups. So these roll-ups are around 35% of that size. We did 2 the first year, 4 the second year, 6 the third year, 7 the fourth year, 8 the fifth year, and 9 acquisitions in the 6th year. Very doable. We do this on a regular basis here at National Diversified. So we know what these futures are. Then the cash flow distributed to owners is 80% of the cash flow. So all along the way, all of this additional money we're going to be creating the sellers are going to get their share of it in the 25% that they own. And we're going to deliver out 80% of our cash flow to us and 80% of our cash flow for the portion that's owned by the sellers that they retained. That's that. Okay, now the next thing that's going to happen is there's going to be a buyer co syndication. In other words, buyer co is a code word for the platform company. So this just gives us what the parameters are for the people who invest in the parent companies as we do as in the platform companies as we do the roll-ups. And these are earnings that we actually get because we syndicate the investors who now make the investment that enables us to do all of these acquisitions. And then these are hard assets that are owned by the platform company that we're acquiring. These are jets that they actually own. They actually have 3 now. So this is going to be changed in the model that we're currently working on because they now have 3 jets that they own and 15 jets that they manage, but they don't own those jets. So they're not part of the assets that we're buying. We're buying the management contracts for those jets in that company, but not the hard assets. Then we go through the source of funds. Okay. How much money is it going to take to buy this company? Okay. And how are we going to get that money? So we start with the use of funds. What do we need money for? Purchase price payable to the seller. We're going to need 45 million in cash, working capital for the buyer co. That's their company that we bought. So we can have working capital additional, $1 million, contingency and a reserve for various debt payments, working capital for the platform company, another 1,950,000. At 950,000 growth capital, due diligence costs, roughly 100,000, accounting, 65,000. These are the various costs. So we know we're going to need $52,991,000 to buy this company. That's the amount of actual cash that we need. And over here, these are all done by formulas because once we know this, because of these various things that are true for charges and things that we have to pay for here, that this is the amount of money that we actually have to raise in order to pay the points and the charges to have the 52,091 left over. And then these are just the factors that we have to deal with. This is how much is going to come from bank loans, 7.8 million. This is how much is going to come from mezzanine financing, net 32,470,000. And the equity investors who are putting up the money, these are the people here that we are going to give safe agreements to, as you will see when we do this. Okay, this is where all of that comes together. So how much you have to raise, because this is how much money you need to spend. Okay, then the syndication investors, this is what they're going to earn. I'm probably getting into way too much detail right now because what I want to do is just show you the sophistication of our model so that we leave nothing to chance. No stone is unturned. Every element is considered. They're all tied together through an Excel master spreadsheet with the algorithms that tell us exactly what happens in each of these things as one interacts and is applied to the other. And then we even take it down to the public offering, what's going to be true of that, how much IPO company market cap is going to be basically in any one of these years, how much of the company will be sold in the IPO, we'll be selling 15% of it. That's going to raise cash. This is the amount of cash it raises. These are our costs. These are all the fractions or percentages of the amount raised, even though these are fixed costs, many of them. They usually fall into a certain percentage range. These are the actual costs, total underwriting and compliance costs, net cash to the company, and even a percentage of the owner's stock. So in other words, our stock, all of these people whose companies we bought who now have stock in the public company, 20% of that total amount of shares will get sold, but now not from the company, but from the owners of the stock. So that gets piggybacked into the offering. And so this tells us the amount of money that goes net to the buyer co, which is our company that gets money from this, and net to the sellers themselves out of this. So this basically just tells us everything we need to know about the public offering. And these can all be changed. Anything in blue can be changed based on you find out something is shifted or it now needs to be recalculated slightly differently. Those numbers are like pivot points. They can all be changed. And that change then ripples through the whole pro forma to give us now the accurate numbers. Those things now being true, what would that actually produce? Hopefully that all makes sense to you, but I wanted to give you the big picture so that you know we don't just pull these numbers out of the sky. It's a very sophisticated process, a lot of research, a lot of mathematical formulations that govern how these things are calculated. And it all gets done in a way that we know pretty much where we stand. Okay, now let's get into the SAFE model, okay, and what that is and how it raises money. These numbers up here you saw before, okay, these come right off of our Proforma projections. And I always come back and point to this one number here that I know you'll remember. It's the $17.9 billion valuation as a Billionaire Lifestyles valuation as a public company, okay? And here's how a SAFE works. what a SAFE is, it's an agreement for future equity, and it's at a discount. Now, the hardest thing to understand about the way that they calculate this is something they call the discount rate. Okay. So here we're offering a discount rate of 73% in the first year if we have a public offering or a funding in the first year. Now, let me back up a second. Why does this thing funding matter? Today, if I were to try and value Billionaire Lifestyles, it's impossible. The company is a startup, basically. It has no income yet, has no assets yet. It has a business plan, a great management team, a great concept, and we've got a tremendous amount of intellectual property behind it. And we've got acquisitions that we're in the process of making. We've got agreements in place. We've got all that stuff. But to put a value on the company is almost impossible. So we don't try to sell people or engage people with our current valuation. We say, we're going to give you instead a simple agreement for future equity. So what you're going to do is you're going to give us $1 million right now. Our agreement says is that we do a funding or anything where the company is valued, where we've now gone through a appraisal, true valuation mechanism. Then on whatever that shows, when we do that funding, whatever we are in effect selling stock for at that time, because we've done the evaluation and the company now has enough resources and momentum and income to be valued. And whatever we sell the shares for, then you get, and this number gets confusing because what it says is the way that the math works, the discount rate is exactly the opposite of what you'd think it would be. What this is saying is the difference between 100% and 73% is 27%. So this says we're selling the stock at a 20% discount. So if people here pay $10 a share, we'll give you enough shares at, instead of $10, we'll give you enough shares at $7.30, okay, that make up your $1 million. So you get more shares than the folks who put up the money at that time. Your discount is 26%, where you pay 73% of what it was, but you've already paid us the $1 million. So you get enough shares to equal the $1 million plus the discount. Okay. So you're going to get, instead of 100,000 shares, if it's worth $10 at that time, you get $1,369,000 worth of stock because you're getting it at a discount for your $1 million. If we did it in the second year, we would give you a 67% discount rate, which means that your $1 million now would have bought you $1,481,000 worth of stock if the valuation was done at that year, and so forth year by year. And if we're public, then it's the public offering that determines all this. Since we plan to go public around no earlier than the third year, and more than likely around the fourth or fifth year, these are the more likely discounts. And if we wait all the way to the sixth year to do it, then they would be getting it at these discount rates. So it means they would be getting, for their $1 million here, they would be getting $2.5 million worth of shares. For their $1 million here, if we went public in the fifth year, at that time, they're getting $4 million worth of shares. And if they did it in the sixth year, they're getting $6,666,000 worth of shares. And if you look at that, their ROI on their investment that they made here when we couldn't value the stock, because at some point we'll be able to value it, by the sixth year, their ROI is 5.7 times. In other words, they got their $1 million back. If they sell it out at that time, they got their $1 million back plus 5,666,667 worth of profit. Their compound annual growth rate was 37.2%. Okay, so that's the power of this particular agreement, is it enables us to pay for this $1 million here, not with equity in the company now, because we don't know what it's worth. But when we know what it's worth, we pay that $1 million by giving them much more value in stock at that time based on these discount rates. So just so everybody understands, and I'm going to hit you with this a couple of times to make sure you're connecting with it. If it says 40% discount rate, it means you're buying the stock at a 40% discount or 60% of its selling price. Okay, here you're buying it at a 15% discount rate. So here you're buying the stock, you're getting $6.6 million worth of stock because your price for the stock that you paid $1 million for is determined now here. And so now, because of these discounts, you're getting $6.6 million for the $1 million you invested here worth of stock as it's valued at that time. Very powerful concept, because now we don't have to create a valuation here. All right. Now, this is what actually would happen to the shares as we go forward. So assume shares of BLS outstanding. The first year, maybe we had 10 million shares out, but now we've made acquisitions. We've used stock for acquisitions. We've given out other agreements for equity and investment. So we're always adding more shares. And let's say by the end of the 6th year, we have 135 million shares outstanding. And then the value per share, if these are the values up here, if this is what it's valued at, then these are the values per share. This is the discount per share of private. Okay, so this is how much we're discounting them. The value per share if private, discount price per share. This is what they're paying for it. So if the company is value per share is these, then the values that they're paying for that we're using their $1 million to buy stock, instead of buying the stock as if it's $29, which is what it's worth at these times, they're buying it at these prices instead. Okay. Value per share of financing if public. Okay. Then this is the amount they're getting it for based on the fact that they've paid us the $1 million, but their stock that this $1 million is now buying is based on these prices here. So they're getting a lot more stock. So shares to the investor, if private, if we go public, I'm sorry, if they're doing it the first year, this is what it would be. Second year, this is what it would be. Third year, this is what it would be, and so forth for each of those various years. And that's how we get these numbers here that correlate to the numbers that up here. Okay. So if we do the ROI in the third year, their ROI is 2.6 times for private, 7.3 times for public. If they do it in the fourth year, it's 3.1 times ROI, 8.7 if it's public. These are their compound annual growth rates and so forth for each of these various years. So the longer it takes us to go public, the longer we're holding their $1 million without having giving them shares for it. And they've had their money tied up for a longer period of time, which is why we schedule it to give them bigger discounts so that every year it takes us to go public. Yes, we're holding their money, but they're making more money, a lot more money when it happens because of the increasing value of the company and the discount rate being progressive the way we set it up. Now, when we get to the Q&A time, I will try and answer any questions that any of you may have on this. So hopefully that'll take care of us then. All right. So raising capital with a safe, simple agreement for future equity. Let's take a look at actually how it works and how we set it up. Okay. So the first thing we did is we had the $1 million. I just went over that with you. So you see how these numbers came out. Okay. And then we also enable people to have a more favorable discount rate if they use a larger safe. In other words, a safe for a larger amount. Whereas before we had the $1 million investment with an ROI of 5.7 times on a public company by the 6th year. This is all based on the 6th year. Okay. It was $1 million. That $1 million bought them $6,667,000 worth of stock in the 6th year. If they invested $2 million, then the discount rates are different. You'll notice that the first year they're the same, second year they're a little different, and then each year they're a little different. So instead of 50%, it's 52. Instead of 40, it's 37. Instead of 25, it's 22. Instead of 15, it's 12.5. But the difference is that their amount of money is going up by more than double, as you will see. Okay, so they're getting a better deal. They are getting a ROI of 7 times instead of 5.7, a compound annual growth rate on their money at 41.4, and their valuation at the 6th year is 16 million, which is more than 2 times, obviously, the 6 million six. So that's the advantage of going to the $2 million. If they'll go to a $3 million investment, we increase these discount rates even more. And so they're able to have 3 million literally produce 30 million by the end of the 6th year. If they do a $4 million investment, discount rates still get to be dropped even further. So now they've got an 11 times ROI, 52.3% year over year compound annual growth. And so their valuation of that same investment by the end of the 6th year is 50 million. And we keep doing the same thing if they buy 5, if they buy 750, and if they buy 10. So on a $10 million investment, they'd be getting a 14.4 ROI, a 57.7 compound annual growth rate. Their 10 million would be worth $153,846,154 in shares in the company at the 6th year. Okay. It is the value of their shares in the end of the 6th year for the $10 million investment. So you can see how much more powerful we've made it to induce people to want to have higher investment levels, because we have to do a lot fewer of these to raise our money than we do of these. So this is based on the fact that we really need 10 million. And we said, look, if we have one investor and they'll come in and do the whole thing, we'll make it so profitable for them, they can't say no if they've got 10 million bucks to do this. And then in the lesser amounts, we have to now go out and find all these investors, a lot more work, a lot more time, a lot more risk on our part of having to go out and find them all. So we've given more and more discount rate, higher numbers. Okay. So you get a sense of what that does to all of this. Okay. Now, before I go any further, I want to also tell you that there's one more thing that we're doing because we're in the process of raising this money right now. So we know most of the folks that are on our call today aren't sitting around with millions of dollars in cash and capital. But we felt that if any of you, our members, our Bizarre financing members, wanted to invest in one of these, that we would set it up so that they would have a minimum of 100,000. We would keep all the numbers the same as for the non-members that you have to invest 1 million to do. So the 100,000 would produce literally 1/10 of this because it's 1/10 the investment, but still would give each investor approximately 6.6 times their money here. The reason it's a 5.7 here is that's the return on the investment, but you also get back your investment, which is how it becomes 6.7 times here. Okay. Let me give you this URL here. This is the URL of the company that invented this safe, and they support the marketplace with the most updated versions of a safe, and they have all the templates for them. Copy this down. Okay. It takes you to this website right here. And on here, you can click in on these various safe agreements. And then they also have on this website a lot of explanation of the safe, how it works, why their various provisions are in their documents so that you see through a lot of transparency how all this was actually put together by the folks who invented. This was invented, frankly, by the folks in Silicon Valley who were having to finance or buy startup companies, private equity companies. So the private equity company is going to invest money in the company. They're going to bring in outside investors, and yet the company has no way to really value it. So this concept was developed by the Silicon Valley folks, the high-tech folks, to enable people to have an assured outcome for their investment, as opposed to a truly speculative investment where the number of shares they get or the percentage that they get may not mean anything in terms of what the company is going to be worth. And it was invented there, and it's been used extensively for startups and hard to value companies ever since. Okay. So that's this URL right here. So I'll read it to you if you want to write it down. It's http://ycombinator.com/document. All right. Questions. Okay. Questions. Anybody have any questions? I see one. How did you arrive at the discount rate? Are there standard rates? The answer is yes, there are standard rates, and ours are way more generous than the standard rates. The standard rate, as you do any research on the internet on safe agreements, you'll find that the average discount is 10 to 25%. So the discount rate. And remember, we went here. Remember, these are discount rates. Okay. So we got to flip them. Okay. So instead of selling the stock here at a 10 to 25% discount, we made it 73%, which is a 26% discount. So we started out, if we did anything in the first year, with having it 1% better than the high of the range that are typically done. But when we went into further years, we deepened those discounts even more. So this is a 36% discount. This is a 50% discount. This is a 60% discount. Okay. So we went to higher discount rates because what we're doing Proforma so spectacularly well that we wanted to make sure that we shared our profits with our investors in a meaningful way, and that we made it so that it would be very hard for investors to say no. And that not only happens at our top range, but even also at the lower range of $1 million investment, where we start out a point higher in our discount rate, and then we keep getting deeper and deeper. And so even here, we're still giving them the stock at an 85% discount. That is so far beyond anything anyone else does. The reason we did that is because we're carrying it out for another 2 years beyond when most of these safes would likely convert. Okay. So here, even if it converts in the 4th year, we're giving a 60 instead of 25. But if we're holding people's money longer before they have a chance to convert, then we want to reward them with a return on their money that makes it worthwhile for them to be holding that investment for a longer period of time before they convert it into marketable shares or into money. Okay. So we were very generous with what we did. You don't have to be that generous. I'm telling you 10 to 25% is standard. And any good business should be able to return that to those investors in a 3 to 4 year period of time at a 10 to 25% discount. The longer you're going to hold their money, the bigger the rate should. All right. Why would a seller agree to only a 1 year agreement? What happens to the deal if you only get a 1 or 2 year agreement? How does the buyer make up the difference in financing? I'm not sure I understand that. So let me try and explain what might be different than what you're thinking. The SAFE agreement never ends. The trigger that converts it to stock is a determination by a financing or a liquidation. You go out of business and you liquidate the company, then it converts to preferred stock and they get a share of the liquidation proceeds through that. Okay. If we do a private placement of any kind, anything where we raise money, and at the raising of that money, there had to be a valuation of the company in order to determine the shares. We're now putting a value on those shares when we sell it in a actual private placement. So that's when they get their stock. And if it happened the second year, third year, whatever year it happens, that's when the conversion happens. Now, some people ask, what if you never go public? What if you never raise money? That's almost an impossibility. We couldn't grow this company and not do one or the other. So it's unlikely that would happen. But all of these SAFE agreements have no set year in which it has to happen. The trigger is the selling of shares for money in a private placement or a public offering or a merger. So let's say that we merge with somebody else and our stock is valued for the merger because it has to be valued in order to merge with the other company and know how many shares our company gets in the new company or vice versa. Okay, so that valuation has to happen. That would trigger it. So everything is triggered based on those things, not the number of years. So this could be running a year, 2 years, 3 years, 5 years. It could run 10 years. Highly unlikely. Okay, we went to 6 years in the illustration because what we wanted to show is that there is a possibility that in years 3 to 6, the market isn't great for a public offering. And we don't want to go public just to go public when it's going to be hard to sell our shares into that not so good public marketplace. So that enables us to time our IPO so that we optimize the valuation of our company at that time. Can you use multiple safes to fund a deal? Absolutely. Not only can you use multiple ones, because here we want to raise 10 million and we might do a 2, a 3, a 1, a bunch of 100s until we finally get to our 10 million. Okay. But that doesn't it. That would be called Series A. Okay. SAFE agreement Series A. Now a year goes by and we still can't value the company really well. We still can't go into the public marketplace. So now we do Series B. Okay. It's not a private placement. It's not an offering. It's a sale of more SAFE agreements. So we would do the same thing there. The discount rates would be different because we would recalculate everything based on where we are and what our Proforma is showing going forward. Okay. But the answer is yes, you can do many of these. You can serialize them. So you do a series at a certain point, that a year or two down the road, you do another series of them. And that doesn't trigger the first ones because there still is not a valuation on the company. So the answer to your question is very simply, you can use multiple sales to fund the deal. Can you use the SAFE agreement with real estate? Yes, you can. Okay. But you got to put the real estate in a corporation to do it. Okay. And yes, you can do it. And I've never seen one done on a piece of property without being in a corporation. You can do it with a business acquisition. Okay. How are we buying our platform companies? How are we buying our roll-up company? When we buy the platform company, we're going to buy 75% of the company. We're going to give them cash for that. And then we give them a choice. Do they want to keep owning 25% of their company and then roll it into the public company when we go public? Or here's a SAFE that we use these same ratios. And what this does is it gives them the opportunity to participate in all of our growth with the money that they didn't get up front for the company. And it enables them to get a lot more money for their company than they would have gotten had they not used the SAFE for the balance that we didn't pay for in cash. If we paid for a note, they'd get the money plus 10%, right? There wouldn't be any way we would use stock at that time, but we could use cash. We could buy them out 100%. Now, we don't want to buy these people out 100%. Why? Because the people who run our platform companies, we want them motivated to build their company and make it very profitable. So we want them to have an equity interest in what they're doing. And so there are ways that we tie this, even though it shares in the Billionaire Lifestyles total, the eligibility for the SAFE runs based on the profitability of their company. So we create milestones for them. And as they hit the milestones, they're eligible for a larger and larger portion of the SAFE. If they don't hit their milestones, then their SAFE is just simply worth less than if they do hit their milestones for growth. And so there's lots of ways that you can work with things. They are fabulous documents. They are very flexible and they're designed to give people literally an inordinate amount of future value by not taking that value now. Now, the beauty of this for us is if we raise $10 million through SAFEs, Is that a liability for us? Do we have to show it on our balance sheet as a liability? No, because we don't owe money. We don't ever owe money. Okay. They just are going to get equity based on a future time period when the company can be valued. So that 10 million sitting in our bank account goes on our balance sheet as an asset, and it's part of our net worth. And it goes into our balance sheet where now we can leverage that equity money with debt money. So every 10 million of equity money is worth to us at least 3 to 4 times what we can then borrow against it with mezzanine financing is worth that multiple more. So when we raise money with safes for acquisitions or for funding of the parent company, the Billionaire Lifestyles, we're raising equity money that we can now re-leverage and turn it into 3 to 4 to even 5 times the amount that we got. So 10 million can become 50 million, 10 million of equity and 40 million of borrowed money. So again, these are very powerful leveraging techniques. Okay, the next question here is, how long did all the Rollups companies take to acquire or purchase? All our roll-up companies, we projected that growth. If you'll remember, I showed you that where we projected them we make in each of our verticals, we make 2 acquisitions the first year, 3 acquisitions the second year, 4 acquisitions. I don't remember the numbers now, the third year, and then 5 or 6 the next year and 7 or 8 the next year. Okay. Because we're building a team to do these things, right? So the first year we expect to make 2 for each of these platform companies. In fact, when they come in, they already tell us. We've already had talks with and we've talked about them merging with us or coming in and us buying them out. So almost every platform company is going to come with a couple of folks they've already talked to and want as part of their company. So the first year is easy, and we build a team for that particular vertical to go out and do these. And guess what training program we use to show them how to do all this stuff if they're not already high level expertise at that? We're finding that we're able to hire people or former investment bankers to be part of that process. We incent them. We run them through the Bizar financing training program, and we produce people who are very astute and adept at doing this. There's plenty of money. The beauty of this is that we're buying only profitable companies. We're buying companies that have strong cash flows, strong growth. We're going after a whole different company than a lot of people go after. People who don't have money think they got to go out and buy companies with problems. And then they have to go in and fix them and make them worth something. Guess what? It's hard to raise money for those companies. Okay. If you're buying the top of the line company with a lot of profit and a lot of growth, raising the money to do that is like easy. It's easy. Everybody wants to own a piece of that company. Everybody wants to have loan money to those companies. And so you're better off raising your sights using these fantastic tools to do these things than you are trying to put together the more standard type of tools and then just having that hard time trying to turn companies around without the resources to turn them around with. It's a better model. It's just a better model. How do we see the replay of this stream today so we can review the whole setup? And second, how do we get the formula for the safe? Okay. All good questions. All good questions. All right. I maybe can figure out a way to get this up there today just by leaving it on the GoToWebinar platform and then sending everybody that's here a replay button on it later today. It takes a while for them to convert it into a format that you can see it on their platform, on the GoToWebinar platform. If I can find a way to do that today, I will send out emails to everybody who's on this particular call today, and so that you can re-see this. It will be edited and online on our webinar library by this time next week. So I'm sorry. No. Yeah. By this time next week, it should be up on our own library. But if I can get it up sooner on the platform, I'll send you email links to get it from GoToWebinar. Okay. So hopefully that answers your question. The thing that I would encourage everyone to do is to go to this website right here. They're the folks who invented this thing. They've done a good job of explaining it so that other people can use it. They're very motivated to have other people use it. For what reason, I don't know, but they'll also answer your questions because they want people to use their templates and to use all of this. They don't charge for them. There's no charge. They just have them. They're available to you. So definitely go there. Anything else for today? I think that's it. I'm 16 minutes over. I'm not seeing any more questions on there. Let me see. I'm just going through the questions. A lot of good questions. Thank you. Okay. It says, can you unmute me? I have a question. All right. So let me do that. This is fantastic. I live for this. This is wonderful. All right. So that's Dennis. So let me unmute you.
Okay. Can you hear me?
I can.
Listen, great information. As always, Gordon, you're amazing. You're doing great things. I have a question. What is the minimum revenue that you would say that you will go for a company for its in revenue? Because you made a point last time, so a while back, to never cut you. Going after companies with revenues under 2 million may not be profitable? Because a lot of times banks or other investors don't really want to go after those type of acquisitions. They just want to go after kind of like the big fish.
Mhm.
So the revenues that you kind of state, say a company that's only making maybe $300,000 a year in revenue or $200,000, or is there a certain type of minimum revenue for these companies? Could this be adjusted for maybe a smaller scale of smaller companies? Or would you recommend that, hey, if a company is having revenues of at least 2 million, 300 million, what's the minimum that you would recommend? Or at least you would probably suggest with this? I'm sorry, go ahead.
Oh, that's okay. First of all, my recommendation, Dennis, is that you use this on companies that have a tremendous growth potential because that's where you can afford to give these kind of returns to your investors, which make it exciting to them. So you don't want to do it on companies that don't have a good growth potential. The second thing is if you're in your early stage and you're trying to raise $1 million, and so you're going to do this for $1 million worth of safes, whether it's one or three or five number of safes, you're going to do it for $1 million. The thing that you got to realize is you got to have a great business plan. If I were to take people through our Billionaire Lifestyles business plan, they would understand the marketplace we're going into, why it's outstanding, why everyone is coming with us. We don't have any problem getting companies that want to be our platform companies. They literally, once they understand it, they are just all in. And it takes that kind of return and growth to really be exciting to everybody. And what I'm trying to convince everybody here is the only tool you have is a hammer. Then you're going to see everything in terms of nails, and you're going to bang away at nails, and you're never going to have a really big building. On the other hand, if you have a multiple toolkit with all kinds of automated tools and power hammers and different types of tools and forklifts and all the things that you need, you start to see a building project a little differently. Okay. And what I'm trying to share with you is once you truly take the time to understand these tools, see how they're applied, see how you can use them, and then abandon this idea that you are only worth a $2 million business and start thinking yourself as I'm worth $100 million business because I know something that nobody knows out there. I know how to put things together that nobody else can do, or the number of people who can do them are so few. And I know a way that if I have the right company, I can get investors excited. I can get the companies themselves excited about what I'm going to do. For the folks who sell their companies to me, I'm going to give them a great price now and then a great price later again. In other words, you start looking at your plan for how you're going to do this. And you take yourself out of this constant striving and toiling to make a few bucks when the right strategy put in place with relative ease can make you a fortune. Okay. So it's a different in mindset. It's a difference in mindset. One of the first things I did with the people that I now have operationally running the Billionaire Lifestyles at the operational and formative level is I showed them a new way of thinking about themselves and about the business marketplace and about the opportunities that are out there, and that there's certain structures and certain methods and techniques could accelerate their vision far beyond what it had ever been. And then once they got it and they realized that they are a person capable of this, that they have the ability, the knowledge, the expertise, the contact base to do this. And the only reason they haven't done it already is they never had an idea that they could do it. But now that they see how it's done and they see how, in effect, they can do it, they take on a whole different attitude and ability that they didn't have before. And it's not that they're any smarter. It's not that they're any more capable than they were before. It's just that their toolkit has been enlarged to the point where they now understand and believe and have confidence that they can do this.
Okay.
And
So yes, it does. And just bear with me just for a couple more moments here. Okay. Okay. So you stated last time was about having the mindset and I see that it's basically knowing that once you do have the tools on your tool belt, that you can definitely do the job. Right. And that's what's important. So I definitely get that. My other question is just my other last few questions. One is, how do we get involved in as Bizarre students on this type of level? How do we try to get involved? And two, how can we reach out to you if we have maybe some ideas or maybe some other things that maybe we can use as application for, but maybe need some help with maybe some modifications on that?
okay. But again, a lot of what we do here at Bizarre Financing depends on membership level. And we have to
Right.
do that because there's a cost, a time cost to us for anything that we do. So we have Essentials, which is our base, and that's relatively low level of support. But there, if people send me an email, I'm always happy to answer the email because I feel that level of obligation no matter what.
Okay.
People who are part of Pro, they're entitled to using the advisor line. I'll spend a lot more time with them trying to answer their questions and give them some guidance. The level that I do this with is the PIBA level. Okay. So that's significantly more expensive. But what it does is it covers my staff cost and my cost for the time that I spend to help people actually set this up. Billionaire Lifestyles is the outgrowth. It wasn't where this person was headed, but it's the outgrowth of a PIBA student who decided that they wanted to buy a jet charter company. That was their goal. And then as we got into buying a jet charter company, as I began to survey the marketplace and how it is that we could proceed, it just didn't make sense, even though these companies were very profitable, but they were also well embedded in relationships with high net worth individuals. The average person doesn't fly a private jet, right?
Right.
It became obvious to me that this was a candidate for a strategic aggregation. Well, I expanded the concept beyond the original pivot role, which was to do this for a jet charter company, to engaging with this person to do way more than that, to actually take it to the level of a strategic aggregation and roll up and buy up companies that are throughout the range of services to ultra high net worth individuals. These folks have the money to pay for whatever they really want. And all you have to do is to package all this so that whatever you're asking them to do, they're going to really want it. And so that became almost like self-fulfilling prophecy. You're going after high net worth individuals. You want to do something that's big. You want to do something that's exciting. You want to do something that's worthy of their interest. You want to do something that pampers them and gives them a level of service that they can't get anywhere else. And that's what a strategic aggregation can do for them. So there are all kinds of reasons why we accelerated it to this level. But normally we start with at least a company that a PIBA person wants to buy, and we start building out the concept and the strategy from there.
What was the one that you said that I know you said the Essentials Pro, and then you said was another word that you used. I didn't catch it for the
Oh,
next level
well,
up.
we call it PIBA, PIBAs. It stands for Partners in Business Acquisition. We literally partner up with our student, and together we go out and do it together.
Okay. 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 So it's a pivot. All right. All right. Okay.
Yeah, you'll find these
All
things
right.
on the Bizarre Financing website there too. It explains all these
Yeah.
programs and what they do.
Well, listen, I'm not going to take up too much of your time. Always, I look forward to these talks, and definitely, I think you're doing some great things. Definitely, you've been always talking about the mindset, and I think that that's the biggest component. Is like you said, is knowing that once you have the tools, once you have the knowledge, that you can begin to orchestrate and put things in place. Because you have to see yourself doing it, and sometimes, yeah, the vision may be so big, and the dream may be so big, but at the same time you still have to be able to find a way to manage the dream, manage the goal. And you, like you said, have a team and realize that maybe you can't do all this by yourself, but you at the same time, you have to be able to put the pieces of the puzzle together with other people's talent, energy, and resources. And maybe, like you said, contacts where you can just tap in and plug yourself and get that source of energy to go through the process. Does that make sense?
Yes, it does. And one of the things that I want to convey to you, this is really important, the Bizarre Financing Pro level. I know we've done a number of webinars, and in the basic course itself, it's called Building Your Dream Team. And it's how to recruit these very people who you need operationally to do this. Okay. Because I'm a reasonably competent person, but I can't do this by myself. Okay. It takes a team. It takes people who have run these types of companies. Okay. And you can recruit them. If once you've got your concept down and your narrative down and you know how you're going to be of benefit and you know the kind of growth that you can develop with the company, then recruiting that operational person, it can be done. Go in there, how to build your dream team. Okay, if you need, that COO, the chief operating officer, if you need the CFO, the chief financial officer. In other words, part of making this real is you have your management team that you recruit, and all of these people can be recruited in a way where they're here for the end result. That's what they're looking for. They're looking for that opportunity to step out of being an employee and working for a paycheck and working as a principal in a company where now, when they make the money using their expertise and their knowledge, they're going to be making a lot of it for themselves. And that's a strong motivation in people. And people want to be in charge of big things. They want to be important in big things. They want to have the ability to use big resources to accomplish their objectives. So once the people that you're talking to see themselves in the picture, okay, that's how you build out that dedicated team. I'm not saying any of these things are easy, Dentist. They're not. Okay. They're not easy. And perhaps not everyone can do them. Okay. But you can't do more than you can conceive yourself doing. The important thing is for you to study this stuff, to go through these webinars and sections of the course, to listen to them and view them over and over again until they're part of you. And once you see them as part of you, then they become doable. They become possible. I didn't become who I am overnight. I'm literally been in business for the last 50 plus years. Okay. And I can do way more today than I could when I was in my 20s or even 30s. Okay. Because I kept studying, I kept working at it, I kept initiating, I kept innovating, I kept trying things, I kept failing. things that didn't work right. And I went back and said, okay, it didn't work this time. It didn't work that way, but I wouldn't let anything stop me. Okay. I knew I could do it. I knew it might take me time, but I knew I could do it. And I wouldn't let anything deter me. And if it did deter me, I went back and figured out how to, it's not going to deter me next time. Okay. So that's the mindset. That's the attitude that it takes to do these things. And not everybody has it. Not everybody can do it. But I found that anybody who really wants it bad enough will find a way to do it.
Yeah, that's true. Listen, again, I don't know how you take out the time to do all the things you're doing. I'm like, this guy has 24 hours in a day to do all these tasks and everything else. But I definitely do appreciate you, Gordon. Like I said, I look at you as a coral icon. Some of these guys that the first moment I heard your voice and some of your strategies, I was like, who's this guy? And the way that you would present things and the way that you would talk about your ideas and the way you would communicate them, you made it, wow, it was like a magic type thing of being able to put things together and be able to see it and be able for it to make sense. So again, I definitely want to be able to elevate my status within Bizarre Financing. I definitely will send you an email. I definitely did look forward to these things. I hope that you will continue to do these things because I feel like they do bring a lot of value to people who want to have more, be more, and be able to realize our dreams of being either a business owner or just being somebody who's able to be in mergers and acquisitions and acquire companies and do it in a way where we can do it with the best leverage possible. Again, I thank you. I thank you for taking the time to answer my questions, and I look forward to the next one.
Great. And thank you for the nice words, Dennis. I really appreciate it. I want to leave you with one more set of words of wisdom. Okay. You ever go to a baseball game?
Yes.
Okay. There are two types of spectators at a baseball game. Okay. There's the folks in the stands, and then there's the folks in the dugout. Both of them are spectators for most of the game. All right. The difference is that in the dugout, you get guys who come out of the dugout and they walk up to the plate and they swing at the ball. Or they come out of the dugout and they walk into the field with their glove on, ready to play that ball when it's hit towards them. And so the difference that you need to think about within yourself is right now you're a spectator. Okay. You're watching, you're learning, you're studying and doing all this, but you're staying a spectator. What you have to do is get out of the stands and into the dugout. Okay. And that means that you got to come out of the dugout and swing at some balls. You got to come out of the dugout and catch some flies and some passes and some ground balls. Okay. And until you do that, you're going to remain in the stands spectator. Okay. And the thing that I feel is so important is mentally take yourself out of the stands and put yourself in the dugout and recognize you're not a true spectator. You are a player. You are a player who's going to go out there in the field and make things happen. Okay.
Yeah, I appreciate that, Gordon. True wisdom, true words spoken. Again, I appreciate you and I look forward to being on the next one. Thank you so much.
Well, great. Thank you, Dennis. And thank you for the good words.